And welcome back to STS Sharpen the Spear podcast. So good to have you with us. So great to have a new and awesome guest. Andrew is with us. And today we're going to hit some cool stuff. Andrew's going to tell us about what he actually does and how he's able to assist business owners. And it's going to be good. And I want to just, as I always do, stick with our tradition. Andrew, no one knows you better than you. So bring us up to speed. Give us a little backstory. Tell us what you're doing now and what we're going to be getting into today.
Absolutely. Thank you for having me, Richard. I really appreciate you bringing me on here and introducing me to your audience. So thank you for that. Hello, everyone. Andrew Cervenka. I hail from currently outside of Milwaukee, Wisconsin, Oconomowoc, so not too far up the road from Richard, actually. Born and raised a Wisconsin native, a small town in northern Wisconsin called Butternut. Youngest of 5 kids. Father was a small business owner, construction industry, so I spent a lot of time swinging hammers, putting roofing on, and all that fun stuff. But I'm not a finished guy, so I couldn't really take over that business. So I had to find something else that interested me. And in a small town, mechanical, automotive kind of drew to me, And so from 2006 to 2022, I was in the auto industry. The last 10 years of that, a territory sales manager for Cart Manufacturing out of Eau Claire, Wisconsin. So I had my Midwest territory, covered 7 states, selling our product to small business owners, regional distributors, e-commerce resellers, what have you. So developed that territory. Late 2022, my second child was going to be born in September. So I needed a life on the road had to come to an end. I was in hotels 3-4 nights every week, and I just couldn't do it anymore. I missed a lot of my firstborn's early years. So I needed to find something better. Not better, but different, I should say, where I could be home with my family. And, digging through, obviously as a tenured salesman, a lot of job opportunities, but all required travel. So I wanted to find something different. I came across growth architects and their procedures and processes and offer to a small business owner. And I really picked up on it. I first out of the gate, I couldn't believe it was real, honestly, what they do for a small business owner. But the more I dug into it and found the legitimacy in it, I decided, this is something I could really get behind and help the average small business owner with something they have really no idea how to really fully utilize. And what I'm talking about here is the true business and corporate credit that an EIN, a business entity, can have and can build separate on its own 2 feet from the business owner. So that's our program, our processes, and our analyst support help guide a business owner through that process in a relatively short runway. But there are definitely things you can do to get started on that road, and I hope to drop some nuggets here today that spark some interest and some questions of some small business owners to, maybe this is a path I should look at taking.
Yeah, I love it, Andrew. I think what I love to do is, so I believe I was born a contrarian. Okay, so even as a little baby, I wasn't doing what other babies did. I didn't cry. I just hung out in my crib and entertained myself. My mother even took me to the doctor because she thought something was wrong with me. Okay, so I've always been kind of taking different paths, right, than the herd, if you will. And when we connected, I'm like, okay, this has to get to my audience. Okay, because there's usually the really great stuff everybody isn't doing. Okay, they're all doing the average stuff. They're doing the mediocre stuff, right? They're doing what everybody else is doing. And not that it's wrong. It's just, it's not enough. You're not fully leveraging yourself to be the best you can be, and business and taking the advantages of business. There's a lot of advantages of being in business. A lot of people focus on some negatives, because maybe there's too many hours or maybe this, all, but really it's the greatest life to have. Because if you know
Absolutely.
how to work it, right? And that's what we're going to talk about today. Let's start talking about this, kind of start at the top, like the whole reason you do what you do, right? Like what are people going to see? Why do you actually do this? Why is this a thing that you found that's so valuable for small business owners?
Absolutely. I guess the top thing it boils down to with your average small business owner, I'm talking, 25 million and under in revenue. They're as classified by the SBA, their definition of a small business owner under 25 million, which is the vast majority of small businesses in America. But it's really boils down to that personal asset protection. You created this entity, this legal person on paper, your LLC, your S corp, C corp, however you're structured. It's a person in the eyes of the government. That's why you can utilize the tax advantages, because it is another person. Where everything falls short is, like you or I, there can be a credit score for that EIN, that person on paper. Unfortunately, like our FICOs, the tracking and logging of all your good payment history that you're utilizing your business expenses with does not automatically translate to those business credit bureaus. And that's filling in the gaps. Holding the hands of the business owner to get through this process spoke to me. I mean, it's something that can be leveraged, like I said, for personal asset protection, but also for financial stability of your business on paper. It can help you qualify for more funding from, if venture capitalists, if that's you're looking for growth there. If you're looking at government contracting, it definitely matters there that you can bring this business partner of your business to the table and say, yes, my credit, his credit, we're going to be able to grow and adapt and tackle these projects, as they come down the pike.
Yeah, that's really good. I don't know if a lot of people think of their business in that way, as almost like a partner, as a person, right? And I love that, because again, it's think really a little bit different.
Yeah, I was going to say it's really the conditioning. I mean, you talk to the SBA for funding, you talk to your local bank, all fantastic funding institutions, but they're handcuffed by needing that personal guarantee always attached to it. I mean, if you're really good and creative with your banker, you might be able to get some lines of credit or small capital loans without it. But if you're going after bigger fish, thinking of acquisition to grow or real estate funding, you want to get a new location or open a second location, those size of lending with your traditional lenders are going to require a personal guarantee. So there's a whole network out there of corporate funding institutions, non-depository, so you're not moving your bank. But when you have created your business into a business partner, an adult that doesn't need a cosigner anymore, it can tackle this and achieve that growth.
Yeah, that's important. I think a lot of clients I work with too, we're preparing for growth. We're systemizing, we're getting their business dialed in, so it's running itself right. It's kind of self-managed, that kind of thing, and then we can begin to think about scaling. But this is where, like, this work that you do for businesses, this is one of the tools of leverage for a company to be able to increase market share, right? To do the expansion, take on other stuff. So, if you want to dive into that a little bit and why it's so powerful to be able to do this, and what's like some examples of what people have done and can do with this kind of leverage.
Yeah, absolutely. I think one of the greatest success stories that we talk about a lot when we consult with the business the first time, just kind of giving a real world example, is a small trucking company down south. They were about, I think, somewhere in the neighborhood of 10 to 15 years in operation, 5 trucks on the road, doing well. Went to do a small expansion project for their building. I think it was in the neighborhood of 20,000, but they had extended their personal credit and personal guarantee too far with their bank. And they couldn't get that small loan, relatively small. So working through a process like we have, with developing the credit for the entity, they were able to build their corporate credit, business credit, then corporate credit score to from $1,000 available to the entity when we looked at their credit reports. Over a 10-month span of being strategic and getting things reporting to their credit profiles, they amassed nearly $750,000 credit available for their entity, which is able to chop up in different ways. They were getting offers to corporate funding on the EIN for new trucks. Peterbilt, Ford, would write them a $300,000 line of credit to purchase a new vehicle, what have you. So, I mean, it can build extremely rapidly if you go about it strategically and know how the system works, know how to play the game. So that's one of the most fantastic real world examples I can give of how powerful it can be.
Yeah, that's from 1,000 to $750,000. That's
10 months.
In 10 months, that's a significant increase. That's really awesome.
Absolutely.
So let's talk a little bit about the power of this accessibility to this kind of stuff. So, because like you just said it too, this is not next month. Okay. This is a process. Usually it's about a year in average, right? And the process,
absolutely.
is that right?
Yeah.
So
about a year.
Yeah. So so it's an investment in time, right? So you're going to make this stuff happen. But then once you get these tools, this access, let's talk a little bit more about like what this guy did. Now and here's the beauty of it. And we talk about this a lot too, is just because you have access to it doesn't mean you have to use it. Okay. So some people think like, they're like, well, like, what am I going to do with $750,000? Like, well, no, the point, just like a line of credit, it's there for you when you need it. And it's the old saying I was taught decades ago by a very successful entrepreneur when I was in the beginning phases. He goes, listen, you always got to ask for money when you don't need it. Never ask for money when you need it because you'll never get it. Right.
Absolutely.
So like what you do, if you, and this is a strategic conversation, right? This falls under strategy for your business. This isn't a quick fix or a tactical issue. This is strategic. So I always like to encourage all my business owners, like you're planning for the worst. Okay. You're hoping for the best, planning for the worst, and access to capital is what will save you in the worst. Almost hands down, nothing else will, right? If you have this access, again, you don't have to touch it, but you can get to it or use portions of it. This is what's key. And this is what Andrew does, right? You can build it. I mean, that 1,000 to $750,000, like that's a game changer, right?
Absolutely.
Whether they use it or not, another truck, they're buying assets. Even if they're depreciating assets, they're getting wheels on the road and making more money, right? So it's all a good thing. An expansion, like I said, put on another building, whatever that looks like. So let's talk about that, why that's such a strategic aspect to a business. And you can probably give a lot more examples of the uses, but I just want to hit that a little bit.
Yeah, for sure. It's like you said, it's that safety net. The banks are always trying to will give you money when you don't need it, but when you do need it, it's not readily available. So I said before, creating a business partner of your business that you can lean on in the lean times. I mean, just thinking about this strategy. I mean, I really wish I'd started doing this back in 2018 and got so many more of these small business owners prepped for, where I'm going with this, the COVID times. There was a survey done by the SBA in 2022. Nearly 600,000 small businesses closed unnecessarily. Cash flow was the main issue. But on average, that left the business owner personally liable for $83,000 of business debt to a business no longer even in operation. So hedging yourself against that, layering in that protection, being able to make strategic moves with capital that is generally at or stronger rates than you're currently finding in your markets, wherever you're dabbling for your capital, is it can be a gangbuster for making strategic moves. I mean, say you're a small operation in an HVAC, and the opportunity comes that your number one competitor, the gentleman's retiring, and are you prepared to make that strategic move should that come? Maybe chances are he's probably not your best friend. Maybe you're cordial in public, but he's not going to tell you that, hey, I'm selling, and are you ready to make this move? I want to exit in 2 years. Are you going to be ready? No, it's kind of, you hear about it on the street. That's, oh gosh, where am I going to come up with $2.5 million to tackle this? Do I have enough credit available myself, or can I use myself plus my business entity together, the power together, to tackle the funding to take on a project like that?
Yeah, that's a really good point, because there's probably no easier way to gain market share than by buying another business.
Absolutely.
Now, there's two ways to look at it too. I always teach too. Like, it could be a really well-run business, and maybe he's doing that, $2 million or whatever, or doing more or whatever he's asking, or it's a poorly run. It's a business that's operating, but it's got a lot of room for improvement, and you can go in for 40 cents on the dollar and pick that up if you've got the cash. And now you can bring in your ability to systemize and build, right? And you have another influx of capital you can put into it, because he's let everything run down, and you're going to have to, you know what I mean? So there's a lot of different advantages. You can make that move, But again, when you're in the driver's seat because you have access to this capital, that's the game changer for people. You're in the negotiation seat. You're the one who's in control, because you know what you have access to. Some of these, we do a lot of business owners. I mean, they're just looking for that out. I remember a guy was posting for his roofing business, had about 6,000 clients, been in business 15 years, wanted to sell this roofing business, right, and all this stuff. He wanted like 300,000 is what he was asking for his business. And I'm like, okay, it's like an okay number, but it really isn't. 15 years of time, 6,000 customers, and 300 grand is all you're going to get? Because he's not even going to get that. That's the asking price, right? Yeah. So he's going to up with 250 or 200 for 15 years worth. Where are you going with that?
Yeah.
Right? But if you came in, that 6,000 person customer list, there's some value inside that.
No, absolutely.
Okay, I mean, that's a little ATM if you do it right. So if you can get access to that and bring it all back, under all that kind of stuff. But again, you can get that low purchase price because you have access to capital. Come in with a little transfusion, turn all that stuff around, and because you had that access to that 200,000 that you brought them down from 300, and you can do that, and now you're turning this around. Look what you gain. Look at the asset you just purchased and turn that into, but you can't do it if you don't have the capital.
Correct. Yeah. And when you said that 6,000 customer list, I mean, that brings to mind, vertical integration. I mean, what if you were a plumber or an electrician or something in a very complementary area? You pick up a roofing company and 1,000 clients, there probably was some crossover, but even just 5,000 clients that you've never dealt with before. Now you have these two complementary services. I mean, it's just a fantastic vertical integration strategy.
Yeah.
I love that. Vertical integration.
Is.
I love that term.
Yeah, that's a good one. And again, and it comes back to the point of our discussion here. You have access to capital because strategically you've thought about this. You might not know the business you're going to buy, but if you're in that position, so once they're done, so let's say it's a 12-month process. Okay, we'll just make that assumption here. So after the 12 months, what does anything continue? Are you looking at this? Have you learned how to continue to grow that? How does that work, Andrew?
Absolutely. With a service like us, it is a platform where all the data and processes are held. But for that year time, you're getting an analyst from our team that is guiding you in the beginning. Crawl, walk, run. And they're going to bless you at the end of that 12-month process to impart the knowledge in you or whoever in your business is undertaking this, a controller or what have you, to continue to leverage this and continue with the strategies to make it grow to the satisfactory number that you like it to see. I normally say, think of your operational expenses in a 12-month span, true expenses. Take that number, and that is realistically where your company credit availability should be after 12 months. I mean, because if we're able to shift how you're paying for things, because let me break it down. The strategy is utilizing vendors and different creditors and things to pay for your set expenses that you're already paying, just with the knowledge that they are reporting to those bureaus, because 93% of them do not report to any of the Dun & Bradstreet, the Experian business, the Equifax business, the Credit Safe. Those are like the TransUnion, Experian, and Equifax on the personal side, but they're tracking the business side. There's very few things that report to those, and that is the strategy, is being smarter and more strategic with how you're paying your expenses to build that score. And in a 12-month time, if we can capture all of your trailing 12 months of operational expenses, that is the number that you should have available to your business after 12 months.
That's great. Yeah. So it's again, making a strategy to start putting this stuff in place. Again, then you turn them loose at the end. So now you learn the ropes. You're able to do it. So it's not a forever relationship, if you will. I'm sure they can come back and do things, or if they have another expansion with another company. But once they know how to implement this and make it work, I mean, again, that's a carry through from here on out.
Absolutely.
I think just the knowledge of that, knowing that there's a service like yours out there, is so critical, because as entrepreneurs, and I know a lot of guys, again, especially in that 1 to 10 million range, we're guys who wear a lot of hats. We do a lot of the work. We're systemized and we're doing things, or at least we're getting that help to do it. But when it gets to the financial side, like you can come in and say like, well, I'm a really good craftsman, a technician, I'm a plumber, and whatever. And you do that well, and you don't really do the business side well, but then you might start getting the business side dialed in. But now there's the financial side. It's like the third leg of the stool, right? It's like, it's the financial side that most people, even business guys, don't really have a handle on.
No, absolutely.
Because it's complicated. When we're talking about credit and building this thing, this is the uniqueness of it. And I think we talk about a lot, Andrew, is we need coaches, right? Everybody does. Like we all have to. The best athletes have coaches. Whatever, your best business, the top achievers all have mentors and coaches and things like that. So we always want to go outside and find the expert, bring them in to improve our business. If you can get that mindset as continue, and we outgrow our coaches. Listen, middle school football, you don't have the same coaches as high school, which don't have the same as college and don't have the same as the pros. So we outgrow them, but they're all critical at the level where you're at now. So you get to this point, when do you, for you and what you do, Andrew, so the whole point of this is, where do they bring you in? Like, we're a small business, we're 1 to 25 million, that we get that. Like, that's the designation. I think 499 employees is another designation of a small business or less, right? So we have that. So we're there, but how soon would you start doing what you do? Like, I mean, I'm being legit. Like, I don't mean like, hey, I made 200 grand revenue last year. I might not be working on that, but kind of where's the kickoff point where you really want to look at what you offer, where it's truly going to start to be beneficial for you?
I mean, that's a really good question. Of course, I would say day one, but bring it to the real world. Where they hit those the traditional blocks. Where you're gotten to the level of, say, $1 million, and you can't figure out how to get to 3, 5. Those benchmarks, because when you get to those certain points, you've grown so much, you've gotten to $1 million. Okay, how do I get to the next step? That's when I bring in coaches and expertise. You're not just dealing with a bookkeeper anymore. You strategically find a good CPA, one that can give you better tax strategies and things like that. So at those critical points where growth is rapid growth might be the next option to take it to the next level.
Gotcha. Good. Yeah. Cause some people because in startup phase, it's a complicated process, right? And guys are wearing a lot of hats. They're doing a lot of work, putting a lot of hours. So we all have to say yes and no to things, right? So like in the beginning, you're just, let's make sales, see if we can keep our head above water, for 2 years. And then I think that, like you said, I found even in my book, I'm like 1 million, 5 million, 10 million, these scaling phases. 0 to 1, you can kind of get there on your own, right? Like I tell people, like by yourself, you can do that. If you hustle and you stay at it, you can grind and all that stuff's good. But then, like you said, also, now you can't do it on your own. You start passing the first 7-figure mark, you get to 2 and 3. That's not on your own anymore, right? Not only do you need more people, but when we talk about credit and ability to expand and have working capital, this is the time when now you begin to put that in place. And now that's your tool to go from the 1 to the 5 to the 10 to the 15 to the 20. It's a really good time to do it. So it is, as you said, always better earlier. Mm-hmm. And we're, as coaches, we're time compressors. Yeah. You're using my 35 years of experience to save 10 years of misery. Okay. And bad decisions and costly mistakes. So that's kind of the goal. But, at an earlier point, there's a different coach. But now we want to get to these levels where all of a sudden, okay, now, the credit thing, because this is it's so unique in what you can do in this 10 or 12 month period. It can completely change the business. It changes the business owner's mindset because he sees what's possible. Where other people, it's not an option. They might be at 5 million. We got guys who are at 10 million and 15 million, and they haven't tapped into this yet. So It's been so much more difficult, and they're thinking, well, I'm stuck. A lot of them get stuck at these different levels. So I love this this is just something to get you unstuck. right?
Absolutely, yeah, and it is a shame because I do run into a lot of the $1 to $3 million revenue businesses that were in our first discussion. If I can get them to open up, a lot of them do admit, I've trashed my personal credit trying to keep this business floating, and personal credit cards are maxed out. And I can't get capital now because the banks are like, "What the hell did you do?" But I get it. That's they didn't have any options. They took out maybe some unfavorable lending, some loans with the terms that aren't so great and rates that aren't so hot. But it's what they needed to do to make that step forward. And I'm not scolding anybody. I get it, and it's what you need to do in the moment is your only option. But let's start untethering that from your shoulders. Let us take, you said in hats, let us take that one hat, and we'll help you get you in a better position. Because then the option is, if they are in some unfavorable terms and we can build the credit of the business to a satisfactory point, the business has all rights to buy the debt off the shoulders of the owner. And what's that going to do for your personal credit if you have been running up your personal credit cards and trashing your scores and making minimum payments? So it's just it gives that breathing room and helps you sleep a little better at night. I think when you're not the number one stressor in most every small business's life, or even in any person's life, especially these days, money.
Yeah, I think too, and you're touching on it here, but we'll go a little bit deeper. Is like all that personal finance, that personal credit, topping all that out. And I can speak from experience. Do you have any idea what that does to your family? If you're married, the spouse,
Sadly, it
the
ends.
kids, yeah, exactly.
Sometimes it
Because
ends.
because your business is your child, okay, and you'll do anything for your children, right, to keep them
Absolutely.
going, to save their life, right, and you do dumb things. Okay, I did dumb
Yeah.
things. Okay, we all do dumb things, but that's why again I love bringing an option for people
Yes.
they've never thought of. Like and one of the number one mistakes people make, especially in the beginning for a year, 2 years, is commingling the personal with the business.
Of course. Yeah.
And
I think
this is
that's
one of the great separators, right? It's a
yeah.
great separator. So you don't do that because it brings everything. Man, you could do a whole episode just on this, but it's just so much the red flags that go up, right? People using their personal stuff and this and that,
Yeah.
from an
My gosh.
IRS standpoint and everything else. And it's just bad. It's costing you profit
It really
because
is.
of bad interest rates and everything else and just trying to hang on. And then the untold, the mental profit, right? The mind
Yeah.
space, the margin, the time, the clarity, and everything else because you're stressing over that. So, there's a lot of cons to this personal finance side that a business can take off of it. You don't want to mix those two. So it's really, I think it's critically important to understand there is a way and to put the strategy in place sooner than later, right?
Yes.
So that you can free that and not be liable, not have that on your personal as a liability that costs as liability for you personally, and you transfer it all to the business because it's like any insurance, anything in the business. What we want to do, and personally, of course, is transfer risk, right? Where can we take the risk of this and give it to someone else? You have vehicle insurance, you have business insurance, you get your fire insurance, that's transferring the risk of that stuff happening. This is the same thing. When you build
Absolutely.
this business credit, you get that like the 1,000 to 750,000, whatever it's going to look like for you and your particular business. That's a massive risk transfer. Like it's
Yes.
really big. I mean, it's up there with insurance and maybe even greater
Yeah.
in some aspects,
Yeah.
right?
Yeah. I definitely often quote saying it's like another layer of business insurance. I mean, obviously, like you said, you need that business insurance, but if you can hedge yourself against the lean times, have lines of credit that aren't tied to you personally, and again, back to COVID, I mean, really wish I could have rescued most of those businesses, but I didn't know about it. Now I do. Now I'm trying to get the word out there, hence me being so grateful for you having me here today.
Yeah, well, it's, and you using that 2020, 21, 22 experience, so many businesses, and there was is a tangled web. Okay, there's a lot
Yes.
of things, but that loss of capital, that or I should say the the loss of access to capital, that was the majority of that was the death nail for people.
Yes, sir.
It sure is. And it's just, I mean, whether you're a restaurant business or a construction business, I mean, wow, even 0809 was interesting too. I went through all that, lost everything. There was, for me, even personally, I'm like, well, could have been capital. Probably it would never hurt. Right. But I did a lot of other dumb things because I'm an expert at doing dumb things. So I wouldn't just let one thing take me out. I wanted 10 things to take me out. So I can admit that I don't do that anymore, but that there are ways there's just so many tools out there for this thing. And this is one of those incredible tools that I just want people to kind of grab a hold of and understand. Absolutely. There's a way to do this. Right.
Yes.
Any final thoughts on that maybe we skipped over that I missed, that you missed, that we want to bring up on what you actually offer?
Maybe just to explain the scaling and the system. Like I mentioned the business credit bureaus, the Dun & Bradstreet, Experian Business, Equifax Business, Credit Safe. There are more out there, but those are kind of the top tier. Obviously Dun & Bradstreet, if you incorporate, you get mailings and they always hit you up and stuff. So yeah, it's just their scale is based off of 0 to 100. Personal is 350, 850. But there are 4 different tiers to that scale of business credit. To navigate from business credit to corporate credit is the term I like to use because it is that next level on the corporation. Navigating through tier 1 is like you just turned 18. You can only get the JCPenney $500 credit card. Transversely on the business, same thing, small credit lines, but it's utilizing the ones that are reporting, and that score starts to build month over month. And normally it's about 3 months on average to navigate through these tiers. That's why we say it's 12 months time. So as you're moving from tier 1 to tier 2, you get to 80 plus, then you're graduating to tier 2, you get larger, some revolving accounts, maybe some business credit cards in that aspect. But again, I mentioned in the beginning that our personal credit wasn't built off of one credit card, one loan. It was multiple things reporting over time. And that's the same strategy here is looking at business expenses, funneling through maybe at the end of it, 12 to 15 accounts. The more things you have reporting to your credit profiles for the business, the better. Because the more you use of it, the more they want to give you, hence why you can build that number quite rapidly, the 1,000 to $750,000. So it's definitely being strategic there with, there are plenty of fuel cards out there. I mean, heck, even Quick Trip here in Wisconsin, in the Midwest, if anybody's a Midwesterner, you know about Quick Trip, Wisconsin. They have a business account, corporate account, whatever you want to call it, for fueling up. I mean, how often if you're a construction guy, fueling up your trucks? And if you're in Wisconsin, you're going to Quick Trip. So why not have that account instead of paying from your business debit card or your business credit card? Have another account that is reporting that you're going to just pay off anyways. A little more on the bookkeeping side of things to keep a handle on that, but it's going to pay off so much better in the long run if you use a strategy like this and have things that are reporting to those bureaus to build those scores.
Yeah, that's great. That's really a really good point. And we're all doing our books. Okay, every business you got something, but it's in whether it's on a credit card or an account. This is an important distinction you made. You got to pay the bill.
Yeah, absolutely.
Okay, but let's leverage the account of a Quick Trip or whatever to boost your credit score. Because that fuel card or whatever, it's not really going to do it. Right. So let's find who's going to give us that benefit, because we'll call it a non-monetary benefit. Right.
Correct. Yeah. Yeah.
Because it's building your credit score, but it really is a monetary benefit because you're going to be able to have access to more money. Right. So that's a really good point. That's a good strategy. So these are things that you go through, right? You kind of find and you recommend and do this kind of stuff for the businesses.
Absolutely. Right? Yeah. Yep. We have the underwriting for a lot of these vendor accounts. I mean, I tend to lean towards construction trades, manufacturing, high operating expenses, a lot of equipment turnover, yearly or every few years. So it's a great model for those types of industries. And just thinking about, how did I want to say that? And I was going somewhere. Sorry.
Well, I would would say maybe, you're looking at the businesses with a high degree of depreciating assets.
Yes.
Okay.
Yes.
I think if you think about it, because this is kind of ringing in my head here as you're saying this stuff, because again, it's the vehicles, it's the trucks, right? It's equipment. You're building homes. Okay.
Yes.
Now, depending on how you structure your draws and all this kind of stuff with banks, whatever that is, like I have clients who need hundreds of thousands for operating capital, right? Now, why, and some have built that up in their, with their profits, and they have it in an operating account that they can never touch until they sell the business, right? This way, now you can get your money back. That's actually your profit, and use these lines, right, to operate when you can get to those kind of numbers. When you're at 3, 4, 500,000, but you're getting the draws every 30 days or whatever it is, so that really tends to work well and enables you to keep more of your money.
Yes.
Instead of tying it up forever for the next 40 years. You just look at this money that you can never touch, right?
Yeah.
That's not a lot of fun. So
there it is. Can't quite get it.
This is great strategy to keep more of what you have. Because in business, a huge part of all your strategy is keeping more of what you've earned. Whether that's taxes, lines, the whole package. So I think what Andrew does can be just a major benefit to you guys in these businesses, especially when you have, again, more depreciating assets than other businesses, right? There's turnover. You've got 10 trucks. Okay, you've got 40 tires if they only have 4 each, plus your spare. Okay,
right.
So there's there's 50 tires, right? Like go replace 50 tires and see what that costs you, right? Especially on 1 tons and stuff, whatever. I'm just saying, like you start to add up the things that you have, because we help build like replacement costs and all that kind of stuff, right? All this stuff is going to happen, and it only happens at the worst time.
No, right.
You also all of a sudden you got $10,000 in tires you got to put on because something happened, and again, so you're going to pull that out of your profit to take care of that, or take it from a line and get things back on the road, making money to pay for it, right? So
Absolutely.
I'm just throwing out little things like that too, because the little things add up in a big way.
It sure does. Yep, it sure does. And I was picking up where I was, my brain clicked again here. What I was getting at is, yes, we have these very strategic relationships with a lot of vendors and things and creditors. We have their underwriting, so it's a way utilizing a vehicle like us would be to get access to those lines maybe faster. For example, the Menards, Lowe's, Home Depot. That's where I was going with the trades. We have their corporate accounts. We know what the underwriting is. We know you're going to qualify for it. And a lot of times it takes some business credit to get there, or it makes it quicker to get there. You can, if you're using Menards for 10 years, they'll probably give you a corporate account. But if we can get you there as a newer small business in a year and get you a $50,000 line at Lowe's and Menards, and being able to just more strategically, lessen the reins on your cash flow and able to scale and tackle more projects at a time.
Yeah, there's that time compression again. Okay, when we were talking about earlier, it's really important that nothing happens fast enough in business as fast as you think it goes. But anytime you can compress time, anytime you can garner access to something you couldn't have without someone else's influence, help, connection, whatever that is, you need to take advantage of that kind of stuff. Do your due diligence, Absolutely. Take a look at stuff, but don't think, you got all the time in the world.
No,
because you really don't.
Not.
You need to start these processes because they do take time. And the sooner you begin, the sooner you get to that end and get to that place where you now have access to this kind of credit, which is really awesome. So, Andrew, this has been fantastic. So let's do this. How can people connect with you? Maybe have a call with you, talk with you, website. What do you got?
Absolutely. The easiest way, email, phone call. So email is andrewc@thegrowtharchitects.com. You can find me on LinkedIn, Andrew Cervenka. You can find me, the cell number is, I always have my cell on me. I may not always answer, but definitely give me a call.
So I'll put all that stuff in the show notes so you guys got the links and everything else. Andrew, it's been awesome having you on here today. This is, again, those kind of counterintuitive things that a lot of guys aren't thinking of or even know exist. So this has really been powerful. I think guys should definitely get in touch with you, begin the conversation, see what Andrew can do for your business. I'm telling you, it's a game changer, and things are never done changing in the marketplace. We're in for a big ride here over the next few years, and you need to be prepared to weather this stuff. And I'm telling you, you can never go wrong with more access to more money. Okay,
Absolutely.
so let's talk about that. So awesome. Again, thanks for joining us today, Andrew. Everybody, we'll see you again on the next Sharpen the Spear podcast. Thanks for joining us.